It's been slightly more than a year since I started my investment journey into the S&P 500 Index Fund. I hope that in today's video, as I share the one-year journey, my mistakes, and what I plan to do about it in 2024, it will help any one of you out there who is looking to start your investment journey into the S&P 500 as well. Two common questions out of the way. First, which platform am I using? I'm using Syfe Trade because they offer 2 free trades per month in the US stock market, meaning I do not have to pay any fees whenever I buy or sell, and in the long run, that will help a lot. Second question, which S&P 500 Index Fund have I chosen to go with? I've gone with the ticker symbol VOO, which is Vanguard's S&P 500 Index Fund, with an expense ratio of 0.03% as compared to SPY, which has an expense ratio of 0.09%. And then comes the sub-question, why not CSPX on IBKR, which has lesser withholding tax because it's domiciled in Ireland? Between the two, it's 15% withholding tax and 30% withholding tax. The answer to that is that I do not look at the dividend income that comes in when I'm invested into the S&P 500. I have other dividend stocks that I'm currently building in the Singapore stock market. It is more for the capital growth in the next 20, 30, 40 years down the road when it comes to my S&P 500 Index Fund investment. Another reason on why not CSPX on IBKR is a matter of preference over platform. I prefer using Syfe Trade as compared to IBKR, the interface, etc. In addition to that, because of how much I'm investing into the S&P 500 Index Fund per month, it is more worth it having the 2 free trades per month as compared to paying fees and investing into CSPX on IBKR. There is a video that I've watched that has broken down all of this and the comparisons up to which level and how much per month that will make it more worth it to invest into the S&P 500 Index Fund, CSPX on IBKR. I'll link the video down in the description box below. You can watch that after this video. Now let's go into the table where I've broken down the past year's investment into VOO and also the investment mistake that I've done, what I plan to do in 2024. Let's go. This Excel sheet right over here, as you can see, multiple times I've bought into it per month at the start because Syfe Trade's platform as a new user back then, it was 5 free trades. Right now, as a new user, it's unlimited free trades in the US stock market for the first 3 months. Thereafter, it will go back to the 2 free trades per month. In this Notion table, I've rounded up the numbers and totaled it up. Take a guess if you can tell what was the investment mistake that I've made. So in November 2022 was when I first started my investment journey, covered in this video saying that I'm not too late. And for those of you who are watching this wanting to get started, it is still not too late. In November 2022, it was $300. December was $350. January was $140. February was $178. The list goes on. In April and also in June was my lowest amount invested. The current capital as of today is at $2,878. Averaging out per month is USD $260. My average price right now is at $374.85 as of 3rd of January. As of the date that I'm filming this, it is right now at $434.01. The unrealized percentage profit is at 15.78%. On the channel, I've actually had a 6 months return on investment video that I've done back then. ROI was at 8%. Did you guys take a guess as to what was the investment mistake that I've made? It's actually not setting up recurring buys into the S&P 500. I did not dollar cost average my way consistently, and as you can see, how much I've invested into per month fluctuated a lot, and it's very emotionally driven, which I want to correct in 2024. If you take a look at this table, November, December, I've done it diligently, consistently investing into roughly about $300, $350. And then as I saw the price rise in January and also February, I invested lesser. And March, when it dipped, I bought more. Then April, it rose again and I only used dividends to buy. That is the emotion that I want to remove when it comes to investing into the S&P 500. At the end of the day, I'm investing into this for the next 20 to 30 years until the age of 50, 60, 70 years old. I'm not sure when I will actually sell it off. In 2023, the S&P 500 actually gave a return of 20%. Had I invested per month consistently, my returns on investment would have been so much more. So that is what my mistake was, and is what I want to correct in 2024. So now let's go into what my dollar cost averaging strategy will be in 2024. Let's go. I first considered how the S&P 500 will fit into my overall personal finance plan. So from the lowest of risk to the highest of risk, I have CPF. There's also the bonds that I've invested into and will hold until maturity. I do have dedicated videos. I'll link up above and down in the description box below. Then there is also the Singapore banks and REITs, of which I'm investing into, build that portfolio size big enough so that it will generate dividends. Then the highest of risk would be the S&P 500, and I'm also looking at the Nasdaq 100. I have not started on that yet, but if you want me to share more subsequently if I do start, let me know in the comment section down below. My plan is monthly. I will put in USD $400 into the S&P 500, an equivalent amount of SGD $550 depending on the currency conversion at that point of time. Assuming a conservative average rate of return of about 8% on the S&P 500, in 32 years time when I'm 60 years old, the portfolio would have grown to USD $730,000. My capital would have been USD $150,600. I do need to plan on the plan not going according to plan. So if you take a look at the S&P 500, it has given good returns in the past. Whether will it continue in 20 to 30 years time, I'm not sure. Nobody knows. Nobody is 100% sure. I just want a slice of the pie if things do go well, and hence I'm not just invested into the S&P 500, and it is also not a significant size of the entire portfolio that I'm looking to build. This emphasizes the importance of diversification, which brings me to today's sponsor, StashAway. More than this just being a sponsored portion of the video, how I think this would fit the majority of people is you want to invest your money in a more hands-off approach, meaning you don't want to have to spend time to research on a particular stock to invest into, then every now and then have to check whether are these stocks still okay. Then a managed portfolio can actually work for you, and that's where StashAway comes in. They are a wealth management platform that helps to invest our money in a more hands-off approach, have professionals manage the portfolio, and you just go about doing your day-to-day activities. StashAway has two general investing portfolios. One is powered by StashAway, another is powered by BlackRock, an investment management company. How are they both different? The one powered by StashAway is more catered towards the risk level that you are comfortable with. So when you go to the app and you start a portfolio, you do have to indicate what is the risk level percentage that you're comfortable with, and they will cater that portfolio to the risk level that you have indicated. The one with BlackRock, you have to indicate based on the equity and bonds allocation. It has a broader market exposure with more ETFs in that portfolio. So depending on what your style of investing is and what you're comfortable, then go ahead and choose whichever portfolio that is more suitable to your needs. If you want to sign up and you're new to StashAway, you can get your first 6 months investment managed for free for up to $20,000. So look for the details down in the description box below. I hope that in today's video, it has helped you gain a clearer picture of how you can also incorporate various investments so that you are diversified more than just the S&P 500. If you have any questions, as always, leave them down in the comments section below. I hope today's video has been helpful for you, and I'll see you in my next video. Bye bye.